In this week's video, we'll cover a clear, factual, and important message about stocks. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. A few weeks back, when we looked at the long-term and rare signal from weekly moving averages, we said that we picked it to illustrate basic concepts, and we could have used numerous trend-following strategies to illustrate the same thing, which was that the probabilities were improving. So this week, we're going to look at the same concept from a different time frame using different moving averages and see what type of information we get. So we're going to look at concepts, and then we're going to apply them to numerous charts, markets, sectors, commodities, etc. from calendar year 2016. And I believe that the message coming from the charts is quite clear, and it speaks for itself. It's a daily chart of the S&P 500 index. Left side of your screen, calendar year 1994. Right side of your screen, calendar year 2010. As we discussed on short takes this week, stock market's a difficult place. Buy and hold is difficult, and one of the reasons why it's difficult to implement buy and hold over the long term is the massive and inevitable drawdowns that you can get within the context of a bear market. Dot-com bust, S&P 500 lost more than 50%. Financial crisis, bear market, S&P 500 lost more than 50%. We also noted on short takes that managing risk is also difficult because it's very, very difficult to implement properly over a full market cycle because it requires an incredible amount of discipline. Is there anything we can do to help mitigate these gigantic drawdowns here if we are able to exhibit that necessary discipline? The answer is yes, and there's numerous ways to do it. In this video, we'll use moving averages. You can see this volatile mess that we have here called price. Looks a lot easier if we put a moving average on it to help us filter out that day-to-day volatility. This is the 200-day moving average here in red. Clients and longtime viewers of these videos know that all things being equal, the probability of good things happening is higher when the slope of the 200-day moving average is positive. Things get a little bit indecisive when it flattens out, and the probability of bad things happening increases when that 200-day moving average rolls over, as it did in calendar year 2000 and as it did in calendar year 2007. Conversely, the probability of good things happening increases when that 200-day turns back up, as it clearly did here in 2003 and again in 2009. The one important caveat that we've covered on numerous occasions can be summarized with this quote. People think that technical analysis is unreliable because they tend to pick one thing they are comfortable with. The problem is that no signal technical approach works all the time. Remember last week we said there's periods in history where using the 200-day moving average worked very, very well, and there are other periods in history where it didn't work particularly well. But the key takeaway is, during the periods in history where the 200-day didn't work particularly well, there were numerous other moving averages on other time frames that were helpful. Moral of the story from the quote from Market Wizards, and moral of the story relative to how the market model is built: you need to diversify using helpful inputs like the 200-day moving average, helpful from a probability perspective, but you don't want to be overly reliant on 1 to 3 signals because they may not work well for long periods of time. This is the S&P 500. This is calendar year 2000 on the left side of your screen. This is 2001 here on the right side of the screen. In all the charts that we'll be covering this week, our 200-day moving average is in red, and our 50-day moving average is in blue. As we know, markets rather than personal opinions set asset prices, and therefore the study of charts or technical analysis is helpful because technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. Here's something unusual. This looks different than this. The left side of this chart looks different than the right side of this chart, and that will be a common theme in this video. We'll be looking for new chart patterns or unusual behavior or things that look different than they did in the past. The 200-day helps us with longer-term trends. The 50-day helps us with intermediate-term trends. You can see here in calendar year 2000, the slope of the 200-day is up. The 50 is above the 200-day. The slopes of both are up here. This period here in calendar year 2000 looks quite a bit different than this period here. Now the slope of the 200-day is down. The 50 is below the 200-day, and it also has a negative slope. And as you can see, during this entire decline here, our low probability look never flips back to a higher probability look. Another example of the look that we want to avoid. Now let's take these basic concepts for an intermediate term trend and a long-term trend and apply them to calendar year 2016. The vote of the entire marketplace, or the way that we refer to it, the net aggregate opinion of all market participants is reflected in this chart, and it is that net aggregate opinion that moves asset prices, and the net aggregate opinion was net concerning or net bearish in March of 2016. Here we have a full bore bearish look using these two moving averages where the slope of the 200-day is down, the slope of the 50 is down, and the 50 is below the 200. Remember, we're looking for things that look different. The right side of this chart looks different from the left side of this chart. And we know from the past few years, what's the downside of using moving averages? Well, you can get whipsaws, but eventually trends emerge. So if we fast forward to the present day in September of 2016, do we have a new chart pattern or something unusual relative to the look that we had in March of this year? The answer is a definitive yes, and you can see if you're a client why we have adjusted our portfolio over the past several months, because the observable evidence has changed and it has improved. We've gone from a full bore bearish look in this region here, and we've migrated back to a full bore bullish look. It's also noteworthy the 50-day moving average has made a new high relative to this high. Go back and look at the last two bear markets. That never happens during the entire bear market. And we also have the slope of the 200-day turning back up in a favorable manner in June of this year. S&P 500, this is the early stages of the dot-com bust. Why were we more conservative in here? Well, this here with the 50 below the 200 looks a lot like this period here, telling us that the risk of bad things happening is higher. We also have to ask ourselves, does this look here that we have in September of 2016, does this look anything like this? Notice again, once the 50 crosses below the 200 and the 200 rolls over, do we ever see the 50-day moving average make a new high above this high here? The answer is obviously no. We just had one here. This is significant, this new high by the 50-day moving average. Let's compare and contrast the two periods. Dot-com bust. Once the 200-day moving average rolls over and the long-term downtrend starts, we really don't see anything that looks like the 200-day moving average is going to turn back up. This looks quite a bit different than what we've seen recently in calendar year 2016. Also noteworthy, once that 200-day moving average rolled over in calendar year 2000, this is calendar year 2001 here, and the 50 dropped below the 200, notice during the entire decline, the 50 never recaptures the 200. Compare and contrast this look here to the present day look. This really doesn't look anything like this, and this speaks to nothing more than improving probabilities, and this speaks to unfavorable probabilities. We do not want to put our capital in harm's way with a look like this. A look like this is like getting a better hand in blackjack or poker. When you have a good hand in blackjack or poker, do you win every time? No, you don't. But you play the probabilities and you bet and allocate accordingly. You bet and allocate accordingly. Let's take this long-term concept that we've already covered with the 200 and compare it to the present day. .com bear market, slope of the 200-day for the most part remains clearly down the entire time. Financial crisis bear market, the slope of the 200-day clearly is negative during the entire meat of the plunge or the meat of the trend that we want to avoid in this case. This and this really looks nothing like the present day in September of 2016. Could this morph back into something like this? Absolutely, positively, yes. We make decisions based on the facts that we have in front of us. If a new bear market is right around the corner in calendar year 2016, and it's a long-term and devastating bear market in terms of duration or magnitude like these bear markets, we know one thing with 100% certainty. The 50-day and the 200-day will not look like this as they do today during the bear market, meaning observable changes will have to take place. They may take place, but right now the observable changes are taking place and favoring good things happening rather than bad things happening on a relative basis. Financial crisis bear market, once the 200-day rolled over, really bad things started to happen and it remained negative. Present day, it's turned back up. Financial crisis bear market, once the 200-day rolled over and the 50 dropped below the 200-day and we were clearly in a downtrend, the 50 never recaptured the 200-day during the meat of the decline here. Compare and contrast this look with the present day where the 50-day moving average has clearly recaptured the 200-day moving average in red. A fair question might be, what about valuations, Chris? Are you concerned about valuations? Of course, we're concerned about valuations. However, valuations are not a particularly good timing tool. Again, from market wizards. I never use valuation to time the market. I use liquidity considerations, think about what central banks are doing, and technical analysis for timing. So let's look at this quote. If this market wizard is concerned about valuations, he's telling you he doesn't use it to time the market. He uses technical analysis, which we're covering now. It's undebatable and indisputable that the technicals have improved considerably since this period here, and he's also using liquidity considerations. We've covered on numerous occasions what central banks are doing around the globe and how that's impacting liquidity. Another fair question might be, well, everybody's trading the S&P 500 and it can be more easily manipulated because it's an index and they can manipulate the futures, etc., etc. Some of that carries a little bit of weight, some of it doesn't. However, let's look at the weight of the evidence. Let's look at the big picture beyond the S&P 500. Here's the NASDAQ. We can see here we clearly have an improving chart here in September of 2016. Notice in the .com bust, once it rolls over in red, it never recovers. Once blue drops below, it never recaptures red. Compare and contrast that to the present day. And also note here, the 50-day moving average is making a higher high above this level here. Never happened in the .com bear market. Our long-term concepts about slopes in the 200-day trying to turn back up and really has already turned back up in a positive manner from a probability perspective. Continuing with the weight of the evidence theme, the Dow 50-day moving average has made a higher high above the highs in calendar year 2015. The present day here really looks nothing like the financial crisis bear market or a lower probability period. Can trends and moving averages and other signals related to trends be helpful when the market turns at a bottom? Yes, here's your 50-day. It turns back up, calendar year 2009. 200-day turns back up, telling us that the long-term trend and the probabilities are improving. We go from a full-bore bearish look early in 2009 to a full-bore bullish look later in the same calendar year. Does the present day look more like the left side of this chart or the right side of this chart? The answer is clear. It looks more like the improving right side of the chart. And this here is calendar year 2009. This was an excellent time to re-enter long-term trends. 200-day moving average, S&P 500 turned back up in 2003, good things happened. Turned back up 2009, good things happen. On the Dow, it's trying to make a successful turn here. Why do I say trying? It has to hold. This chart can't predict the future. The longer this 200-day has a look like this, the more meaningful it becomes. Let's go back to our quote here. Technical analysis reflects the vote of the entire marketplace and does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. Let's look for new chart patterns in multiple markets in calendar year 2016. Looking at our same 50-day, 200-day, this is global stocks, which includes foreign stocks and the U.S. markets. You can see we have a full-bore bearish look here in March of 2016. If we fast forward to the present day, has meaningful improvement occurred on this chart from a probability perspective? The answer is absolutely positively yes. This looks a lot better. 2003 turn up, 2009 turn up, speaks to probabilities. We're looking at an example for illustrative purposes only. 200-day turning back up here. Economically sensitive energy, March of 2016 has a full bore and clearly discernible bearish look and remains in a long-term downtrend. Slope is down, blue is below red. How do the exact same moving averages look in the energy market in September of 2016? The answer is quite a bit better. We have a full bore bullish look. Emerging markets, it's the same old story, same old song and dance, my friends. March 2016, September 2016, with a much improved and discernible change in the look of the moving averages. How does this look here compare to the look in a bear market? EEM here during the dot-com bust, this really doesn't look anything like the improvement that we're seeing in calendar year 2016. If you're watching at home, you might say, how does this improvement differ from this improvement here? This is incremental improvement here, but there is a difference between this look and this look. Notice when the blue 50 goes above the red 200-day, look at the slope of the 200-day. This looks more like a counter trend rally within the context of an ongoing downtrend. My intermediate term trend improves, but my long-term trend has not improved. Compare and contrast this look with the present day, which is telling us that the trends are improving from an intermediate term perspective as well as a long-term perspective. This is an improving look here, but this look here is less favorable than this look here from a probability perspective. When we go out to broad stock market indexes such as VTI or the Vanguard Total Stock Market, broad basically means it holds more stocks than something like the Dow that holds 30 or the S&P 500 that holds 500. So when we look at something like this, it's an indirect way of looking at market breadth, or the percent of stocks that are participating in the rally. The present day global rally, is it just the S&P 500 or the major indices? Here's a VTI in March of 2016. You can understand why we were skeptical when the stock market started to bottom in February. Why? The observable evidence had not changed in a meaningful way. Look at the slope of this and the slope of this. How does the exact same chart for VTI look today? The answer is much, much better, telling us that there is broad participation in the current rally. And if someone says that it's just the major indices that are rallying, this chart begs to differ. We know when this red 200-day moving average turns up that the probabilities of good things happening have improved. Think of it this way. We've got a crummy blackjack hand in front of us, and if we're playing poker with our buddies, we really don't want to be taking a lot of risk with this type of hand. The only thing we know today is we have a much better hand from a probability perspective, and we will bet accordingly. Does that mean we're going to win this particular poker game? No, it doesn't mean that at all. The same thing is true in the markets. We bet relative to the probabilities. When the probability of bad things happening is higher, we take less risk. When the probability of good things happening is higher, we are more comfortable putting our hard-earned capital in harm's way. This really doesn't look anything like this or this. We know there's a ton of debt in the global financial system, and the history books and the historical script says that central banks most likely will try to inflate it away. This is a deflationary look here in February of 2016 for gold mining stocks. Here we have a clear downtrend in gold mining stocks with a negative and long-term negative slope on our 200-day moving average. If we fast forward to the present day, we can see the turn here where the markets started to figure out that central banks were not going to follow the historical late cycle script and that they were going to remain easy and keep those printing presses going 7 days a week, 24 hours a day. With the help of central banks, stocks have done well and bonds have done well. Gold miners and gold and silver, they haven't done that well. Historically, what can we learn from a turn like this? It's a mutual fund here with the ticker symbol TGLDX. It's a gold fund, physical gold, but most of it is equities related to precious metals, which is what GDX is. You can see here in calendar year 2001, the slope of the 200-day turns back up, indicating the probability of good things happening is higher. This is a move from calendar year 2001 all the way to calendar year 2007. This is a 6-year move in an asset class with a relatively strong bullish trend that can make up for a lot of frustration related to whipsaws, sideways markets, and consolidation boxes. Turn up in 2001, turn up in 2016. When we talk about valuations and markets being extended, precious metals may be the exception to the rule, unlike bonds and stocks that have done well over the past few years with the aid of central banks. Precious metals and many commodities have not done particularly well. We showed the chart of energy with that horrible looking slope of the 200-day moving average from a value perspective and buying low perspective. This is the same mutual fund, TGLDX, ticker symbol. This is the 200-day moving average. Notice it rolls over here, sending up warning flares for precious metals in calendar year 2011. Was it helpful? Yes, it was helpful. Precious metals and many commodities did not do particularly well between 2011 and 2015, meaning this could be an important trend change. Is it possible that we get somewhat of a whipsaw look as we did here in calendar year 2014? Yes, it's always possible. But in terms of the weight of the evidence, ask yourself how many markets are saying the same thing in calendar year 2016. It really doesn't matter what time frame you use or what moving average pairs you use. Moving averages help us with trends. Point to point, this is a long-term downtrend. Point to point, this is a long-term uptrend. Let's look directly at the yellow metal, gold. Not a particularly attractive long-term trend here. However, at this point, some of the shorter term things tracked by the CCM market model were starting to improve, and that's why we did buy gold in February of 2016. Have the longer term inputs to the model improved since then? As you might imagine, the answer is yes. We've gone from a full bore bearish look early in calendar year 2016 to a full bore bullish look for physical gold, or GLD, in the ETF space. Gold's precious metal cousins, silver or SLV, in the ETF world, similar situation. This is ugly. This looks good. In terms of an asset class being out of favor, this is the 200-day moving average for SLV or silver from calendar year 2011, when it rolled over and the probability of bad things happening increased, into calendar year 2015. From a valuation and value perspective, you can make a case that precious metals have a good story relative to the fundamentals with central bankers, relative to the prior and unfavorable technicals, and relative to the present day and improving technicals from an intermediate term perspective and now a long-term perspective. Gold mining stocks and silver both can be incredibly volatile, and when you get a slope like this on a 50-day moving average and this much white space between the 50 and the 200, psychologically you have to be prepared for big and painful give-backs or counter-trend rallies. But the important thing here is when we look at the slope of this, in the blue in relation to the red, and ask ourselves, is this a bullish or bearish trend? We're trying to stay with the trend, and this is September of 2016. So from a longer term and intermediate term perspective, any volatility in here on our time frame, which is a longer term time frame, as it sits now, would be classified as volatility to ignore. Market wizards, Ed Sekoto, never would get out of anything unless the trend changed. There's been some volatility in precious metals lately. This chart here speaks for itself. Compare and contrast the look of the 200-day in 2011 to 2016. How do we use all of this, and how can it help us? If you Google this title here, you can get a detailed response to that question. But in short, the key and net takeaway is the charts cannot predict the future. They can help us with probabilities. We can see from the broad brushstroke of charts that we have just covered and markets that we have covered and asset classes that we have covered, the probabilities unquestionably have improved. They don't tell us anything about new information that will come to light. Therefore, as always, it's extremely important to head into next week with a flexible, unbiased, and open mind, understanding that the probabilities can change when the inputs change. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.